What if I told you that Warren Buffett's 20% annual returns for over 50 years came from a principle so simple, you could explain it to a 10-year-old? Yet 95% of traders and investors completely ignore it, burning through their portfolios like a house fire. Today, we're diving deep into the circle of competence, the invisible boundary that separates consistent winners from chronic losers in the markets. Here's the brutal truth. The market doesn't care about your MBA or how many trading books you've read. In 1996, Warren Buffett wrote to his shareholders, "You don't have to be an expert on every company, or even many. You only have to be able to evaluate companies within your circle of competence." But what does that actually mean? Let me tell you about two investors. Investor A trades everything: crypto, biotech stocks, Chinese ETFs, commodity futures. Sounds sophisticated, right? Last year, they lost 40% of their portfolio. Investor B only invests in 3 sectors they understand deeply from their career in tech. Boring? Maybe. But they're up 25% while the market is flat. Why dabbling leads to defeat, not dominance. Here's what happened to the crypto boom of 2021. According to research from multiple exchanges, over 70% of new crypto investors lost money because they jumped into projects they couldn't explain to their grandmother. They bought Dogecoin because Elon tweeted, invested in NFT projects they didn't understand, and leveraged themselves into oblivion. The difference between winning and losing isn't intelligence. It's knowing where your knowledge ends. Now, let's talk about defining your domain. There are practical things you can do to pinpoint your strengths. Let's start by getting tactical. Right now, grab a pen and paper. I'm going to give you the circle of competence assessment that changed my investing game. Here's the 5-minute test. 1. List 5 companies you could explain their business model to a stranger in 30 seconds. 2. Name 3 industries where you can spot trends before they hit mainstream news. 3. Write down 2 sectors where you can evaluate management quality and competitive advantages. If you struggled with this exercise, congratulations. You just discovered your current circle's boundaries. Okay, let's move on to blind spots, uncovering what you think you know versus what you truly master. Peter Lynch, who achieved 29% annual returns managing the Magellan Fund, called this invest in what you know. But here's where people get it wrong. Lynch didn't mean buy Starbucks stock because you love their coffee. He meant understand the business fundamentals of companies and sectors where you have genuine insight. Take this real example. A nurse invested in biotech ETFs because she worked in healthcare. She lost $50,000 because understanding patient care doesn't translate to understanding drug development pipelines, FDA approval processes, or biotech valuations. Got it? Okay, let's talk about how to turn limitations into areas of expansion. We have to find areas where we know more than most others do when we invest. Charlie Munger puts it perfectly. I don't play in a game where the other people are wise and I'm stupid. I look for places where I'm wise and they're stupid. Your circle isn't static, it can grow. But expansion must be deliberate, not accidental. How do we expand our orbit? How do we apply what we've learned? Here's a 90-day deep dive method for that. 1. Pick one adjacent sector to your current expertise. 2. Read quarterly reports of the top 3 companies for 90 days. 3. Follow 2 to 3 industry specialists on financial Twitter. 4. Track the sector's performance against your predictions. Real-world success stories. Let me share 2 powerful examples. Case Study 1. The restaurant manager. A McDonald's manager used his operational knowledge to invest in restaurant ETFs and individual food service companies. He could spot which chains had sustainable competitive advantages because he understood unit economics, labor costs, and customer acquisition. His portfolio focused on consumer discretionary ETFs outperformed the S&P 500 by 8% annually over 5 years. Case Study 2. The software engineer. Instead of buying random tech stocks, she specialized in SaaS companies. She understood recurring revenue models, customer churn rates, and scalability challenges. When she bought QQQ, NASDAQ ETF, she knew exactly what she was getting, not just tech stocks, but specifically which tech business models were sustainable. Practical steps to apply your circle. Your expanded circle becomes your competitive advantage. While others chase hot tips and meme stocks, you're making informed decisions based on your genuine expertise. One key to applying the circle is knowing when to delegate or decline. You have to learn the art of saying no without FOMO. That might be the hardest part. In 2021, while everyone was buying crypto, Warren Buffett didn't invest a single dollar in Bitcoin. Why? Because it was outside his circle of competence. While others lost billions, Berkshire Hathaway continued its steady growth. How can you avoid being caught up in FOMO? Remember, every opportunity you miss is one less mistake you avoid. Create a Not My Game list of investments you'll never touch, and never touch them. Track what you didn't buy. You'll be shocked how often you dodge bullets. Here's where delegation comes in. We can leverage other circles for collective success. Here's a game-changing strategy. Instead of expanding into areas where you're weak, partner with others who have complementary circles. Example, you understand consumer goods. Your friend understands tech. You each invest in your strengths and share insights. Both portfolios benefit without either person compromising their edge. Let's take a look at how you can protect your time and energy using your circle of competence. Successful traders specialize early in their careers. Linda Raschke focuses on futures, Paul Tudor Jones on macro trading. They didn't become generalists. They became specialists in their chosen domains. The circle of competence is a dynamic, evolving framework. It isn't a prison. Your circle is a foundation. As markets evolve, your circle must evolve too. The key is expansion through depth, not breadth. To maintain your edge, stay updated. Set aside 20 minutes daily for circle maintenance. Read industry-specific news. Analyze quarterly reports from your core holdings. Network with others in your expertise areas. Question your assumptions regularly. Here's your takeaway action plan. 1. Define your current circle using today's exercise. 2. Create boundaries. Know what you won't invest in. 3. Expand strategically, one sector at a time over 90 days. 4. Stay disciplined. Resist the temptation to chase trends outside your circle. 5. Review quarterly. Ensure your circle still matches your actual knowledge. The circle of competence isn't about limiting yourself. It's about maximizing your edge. While others chase every shiny object, you'll be building wealth systematically within your zone of expertise. Remember Buffett's words. The size of that circle is not very important. Knowing its boundaries, however, is vital. What's in your circle of competence? Let me know in the comments below. And if this helped clarify your investment strategy, smash that like button and subscribe for more actionable trading insights.